This video covers some recommended adjustments to your forecast if you're going to use them for valuation. We'll first look at how we are using the forecast and valuation, then cover the adjustments. Using the Sprouts forecasting example, we have explicit forecast for 2019 through 2021. This example uses the basic steady state perpetuity for the terminal value. To implement the formula in a spreadsheet, we just use the NPV function in Excel. We compute each year's free cash flows using our forecast of NOPAT and net operating assets. The terminal column computes the numerator of the terminal perpetuity by applying the 4.5% growth rate to NOPAT and net operating assets. We add the terminal value to the year 3 cash flow since it is denominated in year 3 dollars. The NPV function applies the 8.9% discount rate to the cash flows to get enterprise value. We then subtract the net debt from the December 2018 balance sheet to get our estimate of the equity value. The spreadsheets posted along with this video show the analogous process when formatting the valuation using residual income. Regardless of how we format the valuation, the estimated value depends on our forecasted NOPAT and net operating assets. Now let's look at adjustments we make to the financial statements for forecasting. The Week 6 videos covered adjustments that are helpful for forecasting purposes. The main adjustments there were rearranging the income statement to isolate the components of NOPAT and rearranging the balance sheet to isolate the components of net operating assets. We also isolate depreciation on the income statement and tie it to the PP&E forecast. We isolate amortization on the income statement and forecast it based on the company's footnote disclosures and tie it to the intangible assets. We isolate stock-based compensation if you're going to be forecasting a full set of GAAP financial statements. This is because stock-based compensation is part of the change in equity and you need it to derive repurchases. The main additional adjustment you should make for valuation is to eliminate acquisition-related intangible assets. This is because we usually treat future acquisitions separately from our valuation of ongoing operations. But keeping the acquisition-related intangibles in our forecast will implicitly assume that we're having more acquisitions. On the surface, it looks like the intangibles don't distort the computation of free cash flows, which equal NOPAT less the change in net operating assets. For example, in our Sprouts forecast, the amortization expense reduces 2021 NOPAT by $1.3 million, but that's offset when we subtract the change in net operating assets, since the associated intangible asset decreases by $1.3 million. The goodwill has no impact on NOPAT, and it doesn't change, so it also doesn't affect the change in net operating assets. So if there's no effect on free cash flows, then what's the problem? The problem is when we get to the terminal value. The numerator for the steady state perpetuity is the 2022 cash flow, which is the 2022 NOPAT determined by applying the growth rate to the 2021 NOPAT, and the 2022 change in net operating assets, which is the growth rate applied to the 2021 net operating assets if the assets are growing at a rate G. In the Sprouts example, we had a growth rate of 4.5%. If we retain the 2021 goodwill of $368.1 million, the terminal perpetuity assumes that starting in 2022, that's going to grow at 4.5% a year. This is treated like future cash outflows and reduces the terminal value by $376.5 million, which reduces the end of 2018 value by $291.5 million after discounting. The amortization of intangibles reduced the 2021 NOPAT by $1.3 million, and it's no longer offset by a reduction in the value of intangible assets because the perpetuity formula assumes that the intangible assets are growing at 4.5% a year, not decreasing. This reduces the value of the terminal perpetuity by $225.9 million, which reduces the end of 2018 value by $174.9 million after discounting. The total impact in end of 2018 dollars is $466.5 million, which is over 10% of the estimated enterprise value in this example of $4.3 billion. To address this problem, you simply remove the amortization from the NOPAT forecast and remove the goodwill and intangible assets from the forecast of net operating assets. I also removed the associated deferred tax liabilities, getting numbers from Sprout's tax footnote. After removing the deferred tax liabilities from the intangibles, the average non-current liabilities decreased from about 3.5% of sales to 3% of sales, so I adjusted the forecast accordingly. I'm being a little sloppy here for the sake of showing the computations. If you look at Sprout's intangibles footnote, you'll see that the amortization is not related to acquisition-related intangibles, but to leasing transactions that are ongoing. Similarly, some of the balance sheet values of Sprout's intangibles should remain because they're related to ongoing leasing activities, rather than to acquisitions. Once we make these adjustments, using the adjusted NOPAT and net operating assets, we get an estimated enterprise value of $4.7 billion versus the $4.3 billion that we got with unadjusted numbers. This is a fairly significant difference. The 2019 to 2021 forecasted cash flows are about the same in both cases. They differ slightly because of the adjustments to the deferred tax liabilities in the balance sheet, and also the tax effects of removing the amortization expense. The difference is really driven by the terminal value. The adjusted numbers eliminate the fake capital expenditures that have been implied by applying the growth rate to the acquisition-related intangible assets. This finishes the video on adjusting forecasts for valuation. In addition to the adjustments we made for forecasting purposes, for valuation, we typically exclude the effects of acquisition-related intangible assets from our forecasts of NOPAT and net operating assets.